Good morning, everyone. Welcome to our Phillip Securities Research Morning Call for today. Today, we have several stock counter updates. For Phillip on the ground, we have iFAST, Mapletree Logistics, Keppel Pacific OUS REIT, Parkway Life REIT, as well as Keppel REIT. For results, we have Tesla, Frasers Centrepoint Trust, and Keppel Limited. For updates, we have OUE REIT and Suntec REIT. And we'll end off the session with our usual macro and sector outlook for SG Weekly, Week 44, as well as Q&A. This is the disclaimer slide. Any materials presented is just for educational purposes and should not be considered as financial advice. Now let me hand over the time to Glenn to present on iFAST. Glenn, please.
Hi. Yep. So just do a very quick Phillip on the ground on iFAST. I'm currently in the briefing for iFAST, so I'll just be quite quick. We don't really have much information apart from what we can gather from the announcements and releases that they have given us. So moving on to the next slide. Yeah, so for this slide, I think we're just basically looking at the AUA, assets under administration, growing strongly. So it has both grown quarter on quarter and year on year to yet another record high, and mainly due to the net inflows of their client assets, which is sort of to be expected. And revenue wise as well as net profit has also continued to surge. However, if you look at the trend, it's been accelerating. It's still accelerating, but yet at a bit of a slower pace as compared to the previous few quarters. So I think we will not see this like over 100% kind of year-on-year increase as we have seen in the last 2 quarters. For dividends wise, it's also increased to 1.5 cents, maintained quarter on quarter though. So for the 2 updates or like their updates or guidance that they've given is that the Hong Kong e-pension business targets have been maintained. So this has been the same since February of this year. For the iFAST Global Bank, they haven't really put in much new info, about what will happen. But I don't think they'll be able to meet their expectations, at least previously given that they'll be able to break even by the 4th quarter, which is basically next quarter. But the positive note is that the customer deposits have been growing quite strongly, and I think this is mainly due to their efforts. So our view is that their e-pension will continue to provide the good boost to their earnings as well as to their revenue, going into the rest of this year and as well as into next year, which they're expecting it to have a further boost to their net profits. But I think after this falls off in 2025, so in 2026, they're expecting the iFAST Global Bank will sort of replace the revenue driver and the net profit driver that the Hong Kong e-pension business targets was giving them previously. So I think that's what will happen. But otherwise, for their non-banking revenue, which is their core business, will continue to perform well going into the rest of this year as well as into next year. So anyway, I'll try to answer any of your questions that you have regarding iFAST, as I attend the webinar, and I'll be back later to answer any of the questions you have. So please drop any questions you have there. Yep. So I'll just hand it over to John, and that's all for me. Thanks.
Thanks, Glenn. And good morning, everyone. Yeah, so I'll just run through Tesla's 3rd quarter earnings. It was last week. Next slide, please. We published a report last week as well, titled "A Nice Surprise," but headwinds still around. So for our results, 3rd quarter revenue was roughly in line, while adjusted PATMI or adjusted earnings was above due to higher factory utilization as well as some cost reductions. So when I said higher factory utilization, it's mainly because they were able to churn out more cars. While cost reductions, they did lay off quite a number of workers in the 3rd quarter of this year, which they announced in the 2nd quarter. Overall, in terms of the positives, it was positive because both volume as well as margins started to expand again. If you compare it versus the first half of this year, even towards the tail end of last year, these numbers were actually quite bad. Margins continued to decline, while deliveries, you could see already for the first half of this year, deliveries were contracting, while towards the back end of last year, deliveries were actually declining year on year. So it's kind of a respite, in terms of just overall results. You can see deliveries were up 6%, while margins, actually for deliveries, a big part of it was because China demand was actually quite strong. About 30% of domestic China demand grew 30%, which is good. But I guess if you actually compare it to the overall Chinese EV industry, I believe that the overall EV industry is growing in the high 30% for this quarter. While the biggest rival, BYD, is actually growing about 37 or 39% as well. So even though 30 plus is good, it's still lagging the overall industry as well as its most competitive peer. When you look at margins, the rebound was quite a relief when you look at both gross margin as well as auto gross margin. Auto gross margin is essentially basically auto revenue divided by auto gross profit divided by auto revenue. And this is excluding regulatory credits that they have that they earn quite a bit of that they sell to other car manufacturers. But essentially, you can see here margins on a quarter basis was up 60 basis points for auto. Overall gross margin was up 180 basis points quarter on quarter and 190 basis points year on year. This 190 basis points year on year is the largest expansion since the first quarter of 2022, when its gross profit actually grew by 2x. So it's quite significant because we are starting to see a little bit of I guess more efficiencies coming through, which hasn't really been the story for most of this year. Like I mentioned earlier, higher utilization. They're also bringing down the cost per EV. I believe they brought it down by about 5 or 6% year on year. So they helped to offset some of the higher costs, and at the same time, there were lower material costs and so on. So overall, quite a good story for margins and just deliveries as well. In terms of the negatives, we saw a 7th straight quarter of declining ASPs. This is a little bit concerning because they also introduced their new Cybertruck, which is much higher ASP versus its Model 3 or even the Model Y. But at the same time, it's also not surprising because the whole purpose of Tesla and their commentary is always to drive a more affordability for EVs. So in some aspects, their goal is actually to reduce ASPs to get it down to something below the 30,000 range. Right now, ASP is about $45,000. And that's actually where during the call they also introduced and reiterated their low-cost EV model that will go into production in the first half of next year. So this when you say low cost, it'll be below $30,000 and it's catered to the mass market. So it'll be very comparable to some of the more popular ICE models like your Toyota Corolla, Camry, and so on. The other negative is that they expect slightly higher capex for this year. Instead of 9 to 10 billion, it's now about 11 billion. So it's about 10 to 15% higher than originally expected. And they're spending a lot of this capex not really on building cars, but actually on acquiring more GPUs and building out their own AI infrastructure. So we expect this to weigh slightly on valuations. Next year as well will continue to be a build-out year. So you should expect a similar story there for capex. In terms of our outlook for Tesla, the new low-cost EV is expected to drive 20 to 30% sales for next year, which is good from a volume perspective. We're not really quite sure how that will pan out in terms of a margin perspective because if it's lower cost, or rather it's a lower ASP versus it's going to be 30% lower ASP versus the rest of the cars. We're not sure if it will actually be 30% cheaper to manufacture. And Tesla never really gave much description of it. Just said it will drive 20 to 30%. So it's positive, but we take it with a pinch of salt because we don't really have all the details there. But yeah, we're still cautious in the near term. Obviously, Chinese competition is still very strong. You can see just from the quarter alone, right? Even though Tesla grew 30%, their competitors are still taking market share away from them. And even outside China, there's a little bit of softness in demand. People are actually switching away from these and actually going back to hybrids like the ICE vehicles. And lastly, in terms of valuations, right now it's trading about 105 times 2024 PE, which is very steep. Relative to how much growth it can be. So if you think because of these three things, still very cautious, waiting to see much more clearer margin and volume expansion trend before we turn maybe a little bit more bullish. The good news is that at least in 2020, towards the back end of 2026 and 2027, is a rough timeline for when some of their quote unquote software revenue will come in for taxis and can expect FSD to start ramping up quite significantly from then. It's just that's like 2-3 years away, so it's still kind of ways away. In terms of our valuations, we upgrade from a sell to a use. We raised our target price to $230 US, mainly because we raised our 2024 PEG by 14% due to further margin upside, as well as higher dividends. Yeah, so that's all for Tesla. I'll hand it over to Darren to continue with the rest of the
Yeah, thanks, John. Yeah, I'll talk about Frasers Centrepoint Trust's full year 2024 results. So the title is Upside from Tampines 1 AI Completion. Yeah, because they just completed the AI at Tampines 1 in August. Yeah, next slide, please. So for the results, it was in line with our expectations. So the gross revenue and NPI is down about almost 5%, but that's mainly because there was absence of contribution from Changi City Point this year, as well as the Tampines 1 AEI, which was saw some downtime. Like the Tampines 1 continued to operate, but it was partially down due to the AEI works. So you exclude all these Changi City Point and the Tampines 1 effect. Basically, the NPI for 2024 was 3.4% higher year on year. So the finance cost, it peaked at around 4.3% in the first quarter of 2024. Now it is at about 4.1%. It's dropped since the fact that they paid off some of the higher cost debt using some of the divestment proceeds from Changi City Point. Yep. And for distributions for investments, it also rose by quite significant amount, 30%. That's because of the 24% additional interest in Next, which they purchased and completed on 26 March. And as a result, the total DPU for the year was flat year on year. So yeah, so that's the results for FY24. And moving on into the narrative, the story, the positives for them was that they had some stable retail portfolio occupancy quarter on quarter, so no change at 99.7. So all of their malls had a portfolio occupancy at a mall occupancy of more than 99.3%. Only Tiong Bahru Plaza was slightly lower, 98.3%. So that's also very strong. The tenant sales right now is 20% above pre-COVID levels. So because of the strong tenant sales, the occupancy cost remains low at about 16%. Pre-COVID levels historically is about 17%. So there is still room for FCT to drive up rents. The tenant sales and shopper traffic were up 1.2% and 4.2% year on year. But tenant sales seems to have moderated. Like the growth is still slow, but the outlook for the sales are still quite strong. So the fact that the tenants are willing to pay higher rents basically just indicates that. They also had some healthy, strong financial position. Like I mentioned, the low stable cost of debt, the improving stable cost of debt quarter on quarter. They also have 71.4% of loans that already hedged to fixed rate, and most of their interest rate swaps are already kind of mark to market, so they do not have any cheap interest rate swaps remaining. So basically, we expect the cost of debt to remain around 4.1% or even improve going forward into next year. Yeah, the gearing is also healthy at 38.5%. So this end of this financial year, they did a portfolio valuation. Yep, and it was up 1.2% with unchanged cap rates. So that just shows that Singapore's retail assets remain highly desirable, and the value is there because of limited supply. And for the outlook for T1, after they completed, outlook for FCT, after they completed the AI at T1 on schedule, which saw another 9,000 square foot of NLA added into prime retail space. So they are now doing a Hougang AEI, so that's their next AEI that is planned. So for the T1 AEI, they managed a return on investment of more than 8%. So that was better than the initial target of 8% basically. And for the Hougang AEI, which will commence in 3 quarters time, so starting calendar year second quarter 25, so it's the April that quarter. The Hougang AEI is expected to be about 51 million capex is expected to be put into the Hougang AI, and the target RI is about 7%. So this AI will expand the CSFS, or the Community Sports Facility Scheme, by about 11,000 square foot of NLA. So that will bring that to about 27,000 square foot of NLA. And the mall will continue operating. So it will be something similar like the Tampines 1 AEI. Parts of the mall will continue operating, while the other half that's undergoing AI will just do the construction. So there will be some downtime and there will be some loss of income there. But FCT, they have indicated that they'll collect more management fees in units to kind of offset the loss and the impact to DPU from this AEI. So similar to what they did with Tampines 1. And right now, for FY24, they paid 70% of the management fees in units to offset the loss of income from Tampines 1. So something similar, they'll do something similar for Hong Kong Mall as well. So for their inorganic growth opportunities, it'll include the acquisition of the sponsor stake in North Point, City South Wing, as well as the remaining 50% stake in Next. Yeah, so our outlook for rental reversions is still about 5% strong. Yeah, because tenants are basically they're still willing to pay higher rents. And we maintain our accumulate call, slightly higher target price of $2.44 after we roll forward our forecast towards FY 2025 and 26. And right now, FCT is paying a yield of about 5.4%. Yep. Next slide, please. I'll move on to MLT. So MLT also released their results last quarter. So do a flip on the ground. Yeah, so MLT, as you all know, is a logistics REIT with global presence. So just some snapshot of their first half results. Their financial year end is in March. So this was a first half results. Their MPI is down 1.5%, but there are a lot of movements over the quarter year on year for them. So some of it were higher contributions from Singapore and Australia, but weaker contributions from China from the weak rental reversions, and there was some FX weakness as well. And during the quarter, or rather during the past year, there were also many divestment acquisitions. So the 1.5% down year on year impact on MPI is not the same store sales basis. Yep. And for them, their cost of debt remains stable at 2.7%. So it's been around this level for the past 3 quarters. So no change. But going forward, they expect their cost of debt to increase slightly for the rest of the year. So they're guiding about 2.8% this year, and next year around flat 3%. So that's because some of their interest rate swaps are still at a cheap rate, and when they reprice it, it will be higher. Right now, their percent of fixed is still very high, 84%. So for them, the overhang is still the rental reversions in China. So right now, the portfolio rental reversions in the first half is minus 0.6, but if we exclude China, it's 3.6% up. So China rental reversions were minus 12.2%. So for them, tier 1 cities was minus 3%, while tier 2 cities was minus 13 to 14%. So for them, their outlook is that they expect the China rental reversions to remain around this low double digit negative for the next 2 quarters. However, after that, they expect it to slowly increase, rather the thing to reverse and the rental reversions to reverse and slowly to improve back towards a low single digit levels. That's also partly because about 90% of their China leases have already been marked to market. So there's just a little 10% left that has yet to be marked to market. And we expect the quite significant negative rental reversions for those 10% as well. Yeah, so for them, they've made some acquisitions year to date, 220 million, and they've indicated that they will not do any EFR. So any further acquisitions for the rest of the financial year will be funded through their divestments. So far, year to date, they've divested 120 million, and they've a pipeline of about 1 billion of assets that they want to divest. So half of it is from Hong Kong and China, and their target this year is about 300 million. So right now, so far about 120 million. And for the outlook for them, the Singapore rental reversions is expected to slow to low single digit levels because there's some new upcoming supply. And like I mentioned, no EFR is expected. And interest rates are expected to creep up to about 3% next year. Yeah, and for Maple Lock, right now they are paying a dividend yield of 5.9%. So for Mapletree Lock, the weakness will still be from China mainly, which accounts for about 20% of their income. Yeah, next slide, please. Yeah, we move on to Keppel Pacific US REIT. So for Core, they released their results last week, and we also hosted them for Corporate Insights webinar. So the highlight for them is the NPI is still year on year down, mainly because of slightly lower occupancy, 88.7%, and higher finance costs as well as some higher property expenses, as a lot of basically the physical occupancy is higher. Now it's at 73%. So that's roughly about 3.5 days back to office for the US. So that's already quite high for the US. Yeah, so for them, the capital management, they have a chart on the bottom right. So you see that's the expiring debt maturity profile for them. They have another 3.3% of their loans. So that is about 20 million that's expiring December 24. So that has been really, it can be paid off easily as they've already secured a new uncommitted revolving credit facility in October. So no issue there. And in 2025, they have another set of loans that are expiring in February. So that also can be used to pay off the existing facilities as well as the cash on hand, because they halted dividends. So they have some additional cash that they can use to pay off the refinancing for the near-term loans. Yeah, so for them, the rental reversions is negative 1.2% for 9 months. So there's a known vacate at the plaza. So now they're backfilling that space, and they managed to sign a new lease there. So for this new lease, it was minus 3.5% down, which was a slight negative rental reversion, but the tenant improvements, or rather the tenant incentives, were much lower. So as a result, the net effect was positive. So net effective rents were actually higher. And this new lease comes along with a 5.4% positive rental escalation as well every year. So that is a good signing for them. And for the outlook of portfolio valuations, even though interest rates have already declined, they're still expecting some weakness, but the impact to portfolio valuations might not be as bad as what we saw in FY 2023, like 2022 to 2023, there was a huge decline, but we don't think that will be a similar case, but there will still be some weakness for portfolio valuations, but we don't think that the devaluations will be high enough for them to breach the 50% limit. Because right now the gearing is at 42.6%, but we don't think it will be that significant to breach the MAS 50% gearing limit. Yeah, so for them, the outlook, the occupancy will remain around 89%. And for them, really, if they want to resume dividends, they mentioned a few things that need to happen. So one of that, it is depending on the successful refinancing of all the loans in 2024 and 2025, as well as the gearing, to make sure they don't breach, or rather remain around this low 40% and do not breach the 45% or 50%. So they also want to divest some assets to free up liquidity and cash for them. So those are the two key factors for them before they even consider resuming distributions early. But the plan now is still to resume in the first half of 2026. Yeah, and the issue that remains challenging is the fact that the transaction volume is still slow, even though it's been improving with the lower interest rates. But the banks are basically still not lending to fund any office purchases, especially since we've seen recently their peers, Manulife and Prime, both of them divested a property each, and both also were 100% cash basis, fully equity. So yeah, really there is no bank lending, or no liquidity, no funding for office real estate for them, for the US market. Yeah, so that's all for Keppel Pacific. I'll hand over time to Miao. Thanks.
Thank you, Darren. So OUE had their result last week. Next slide, please. So well, DPU was not disclosed. Third quarter 24 results are in line with our expectation. OUE REIT will resume paying 50% of the base management fee in cash. with the remaining in units, which we expect to partially offset the weaker contribution from hospitality segment in FY24. And something positive is rental reversion in Singapore is holding up well, with 16% for Mandarin Gallery and 10% for Singapore office segment. And occupancy in the CBD area dropped it marginally by 1.7 percentage point to 92.2% amid the completion of IOI Phase 2. And we expect pressure on the vacancy rate to alleviate in 2025 in the face of the construction delay of the Shaw Tower. And so we expect rental reversion to maintain at the mid-single digit in FY25. And we do expect cost of borrowing, we do believe cost of borrowing is already at its peak, and interest rate headwind will be significantly unwind in FY25. However, since most of the borrowing has already been hedged for at least 1 year, the all-in cost of borrowing will still be much higher than the pre-rate hike period, which was 3.2% in third quarter 21. So this may negatively impact DPU in 2025. And for negatives, we do expect RevPAR to taper off, although RevPAR increased by 0.3% year-on-year to $269 in third quarter 24. But revenue for the hotel segment declined by 1.8% year-on-year due to lower variable rent from the master lease. And Singapore market has experienced a softening in ADR from the peak last year as a trade-off to maintain its occupancy rate, driven by the normalization of tourism spending on accommodation. And RevPAR for Hilton Orchard declined by 8.6% year-on-year in third quarter 24. Well, Crown Plaza delivered a pretty strong performance with 30.3% year-on-year increment in their RevPAR, since corporate demand such as cabin crew remain robust. Next slide, please. And for outlook, the retention rate for office space remains strong for OUE REIT, given its connectivity and also cost consciousness of the corporates when considering relocation. And 60% of the IOI building has already been pre-committed, with another 10 to 20% under negotiation. With a healthy pre-commitment rate and also lower than market rental rates, we do expect rental reversion in FY24 to maintain at high single digit and FY25 maintain at mid-single digit. And OUE REIT has observed more constrained spending pattern in Mandarin Gallery as shoppers shy away from luxury products and instead they turn to health and wellness offerings. Occupancy cost has risen across the board, with Mandarin Gallery seeing 1 to 2% uplift. As tenant sales continue to trend at 85% of pre-COVID level, and also inflationary pressure exacerbate margin constraint, we forecast rental reversion to moderate from the current high in FY25 to around high single digit level. And outlook for hotel, OUE observed that Chinese customers are becoming more price sensitive. And for room rate next year, Chinese are very likely not coming back to Singapore, where room rates elevated since F1 and Golden Week will be overlapped in 2025. So ADR in third quarter will trend down further. So however, Hilton is not targeting the price sensitive group and will be and will be driving more corporate sales to sustain RevPAR in 2025. And OUE is currently trading at FY24 dividend yield of 6% and also attractive valuation of 0.5 times price to NAV. So we maintain a buy recommendation with unchanged DDM back target price of $0.4. Next slide, please. So moving on to Suntec REIT. Next slide, please. They released the third quarter result last week and was in line with our expectation. Third quarter 24 DPU stand at 1.58 cents, and 9 months 24 DPU forms 75% of our full year estimates. For positivity, rental reversion in Singapore remain robust, achieving 20.9% for retail and 10.8% for office. Although tenant sales decreased by 1% year-on-year in third quarter 24, but occupancy costs in Suntec City remain stable. And we expect rental reversion at mid-teens in FY25 through trade mix rebalancing to attract higher yielding tenants from F&B and also entertainment sector. And we expect rental reversion in FY25 to maintain at high single digit for office segment. And for negatives, overseas asset continue to drag. While backfilling of the overseas property is on track. The occupancy rate for 55 Carver Street is still subdued at 61.4% and expected to improve to 64% by the year end. Suntec believes leasing momentum in overseas market has yet to regain its full strength due to high incentive in Melbourne and Sydney, and also very weak physical occupancy rate, as employees are reluctant to come back to office. Melbourne's office market is particularly challenging, with a CBD area vacancy rate reaching 19.6% in first half 24. And this is comparable to the very high vacancy rate in Shanghai, which was 21.7% in first half 24. And also it's even worse than the major US gateway cities, which was 16.5%. We expect additional pressure to come from the year-end valuation due to the potential cap rate expansion in Australia. We anticipate asset devaluation of around 400 million, which could rise gearing to around 45% by the year end, assuming a cap rate expansion of 70 basis points. We expect year-end valuation for UK asset to hold up well, with potential upside to come from Singapore market due to very resilient rental reversion and strong operational performance, which is expected to partially offset the asset devaluation in Australia. And leasing demand remain robust in Singapore, with 30,000 square feet previously occupied by Pure Fitness, has already been successfully fully backfilled with a positive rental reversion. Although the low rent cycle has already passed and lease signed during COVID has largely expired, we still anticipate that revenue from the retail segment to support DPU in FY25, as 5 to 7% of the revenue derived from GTO, and this has not been reflected in the rental reversion figures. And we expect all-in cost of borrowing to edge up to around 4.3% in FY25. So Suntec is currently trading at FY24 dividend yield of 5%, and also pretty attractive valuation of 0.6 times price to NAV. We downgrade Suntec REIT to accumulate from buy with a lower DDM back target price of $1.36. Previously it was 1.41. And FY24 to 25 DPU of 6.2 to 6.96 cents, due to deteriorating NPI margin, lackluster overseas performance, and also a slowdown in large-scale events in Singapore. And next slide, please. So this is a Phillip on the ground for Parkway Life REIT. Next slide, please. Yeah, so we don't cover Parkway Life REIT, so it's a non-rated. And we view the recent acquisition positively, both from the financial and also a strategical point of view. Parkway acquired 11 nursing home property in France for total purchase consideration of 159.9 million, with a buy and lease back agreement. So the property will be leased to the second largest nursing home operator in France, which will ensure a 100% occupancy rate. And the acquisition will be fully funded by equity fundraising and expected to result in a 1.6% DPU accretion. As the share price is currently trading above book value, the acquisition will be 4.4% DPU NAV accretive. Gearing is projected to decrease from 35.3% to 33.3% pro forma first half 24 basis. So the lease structure will include indexation linked rental escalation to ensure very stable income with some step up in the earlier years. And net property income yield of 6.5% and occupancy costs around 20 to 30%, which is in line with the market rate. And we do expect additional upside to come from saving in effective tax rate and also income hedging, as the current financial projection assumes 70% effective tax rate. And Parkway Life is very actively engaging with IRAS to reduce the tax rate, and they aim to reduce the tax rate to a very minimal level. And they're also planning to take on long-term income hedging to buffer against the exchange rate volatility. And for the nursing home market in France, Parkway do believe is very favorable, and France is one of the Europe's largest private nursing home market, valued at 19 billion, with very high barriers of entry and very restricted regulation. With over 22% of its population aged 65 years old or older, the country faces a shortage of aged care facility and offering very few than one bed for every 10 seniors. The government subsidizes around 60 to 65% of the nursing home cost, with the remaining will cover out of their own pocket. And no new nursing home beds are expected to be authorized until 2028. Yeah, so with the first acquisition in France serving as a cornerstone, Parkway Life is expanding into the new geography, with Europe now accounting for 6% of the revenue exposure. Yeah, next slide, please. Yeah, so it's a Phillip on the ground for Keppel REIT. Next slide, please. They announced the third quarter result last week, and they have a pretty strong set of results, mainly supported by high portfolio occupancy and also income from its recent acquisition of 255 George Street. And however, distributable income decreased by 1.6% due to rising financing costs, and rental reversion continued to be on the upward trajectory, with 9 months 24 positive rental reversion of 10.2%. And it was largely driven by the higher rents in Singapore. Gearing increased to 41.9%, and primarily due to acquisition of the George Street and also its anniversary distribution in first half 24. And management is committed to lower leverage ratio to below 40% through divestment, including selling of its mature asset and also partial stake of the existing property. And we do believe occupancy rate to drop a bit in 2025 due to supply influx and also weaker macroeconomic environment. So media reported that NNP is very likely not to renew the lease for the 6 floors in Ocean Financial Center upon their expiries in 2025. And the management is in advanced negotiation with potential tenants, including legals and professional service firms, to backfill around half of the space that BNP will vacate. So positive rental reversion is expected to generate for Ocean Financial Center, and will generate positive with 2025 outlook due to lower interest rate for the 900 million refinancing in the upcoming year, and the borrowing. Yeah, so this represents around 22% of the total borrowing. And we expect the all-in cost of borrowing to maintain at mid 3% in 2025. And year-end valuation is anticipated to be stable, and they also don't have any EFR plans in the near term. And we do expect 2025 DPU to be supported by the pretty resilient rental reversion of mid-single digit for its Singapore asset. And also, Keppel REIT doesn't have much experience in Australia for the upcoming year. Yeah, so they'll be less affected by the high incentives in Sydney and Melbourne. Yeah, so that's all for me. I'll hand over to Paul for Keppel. Thank you.
Yeah, thanks, Meow. Oh, sorry. I'll just move on to Keppel's results. So Keppel gave an update third quarter 24. There is no financial details, just an update. Next slide. Okay, I'll move on to the if you look on the left, that's all they give on the financials. And net profit was comparable year on year. So that's the only numbers I have to share. So for the results, the limited financial provider, except they said that 9 months was comparable. So we assume, because first half was higher, so we are assuming the third quarter earnings was probably down, and down mainly because of real estate. I think this has been well flagged. I think real estate, especially in China, property development. So you're going to have weakness there even until the fourth quarter. But next year onwards, because it's down so much, you won't have that negative year-on-year base comparison. So this year, you're still going to have the weakness because of the property sales. But some of the positives we got from the update was that multiple assets are ready for divestment. So the key one or the main one we always look or we always ask is the REITco. So you know that REITco, there are 4 billion of REITco assets. Or actually it's a note, think of it like vendor notes, where if the vendor sells some assets, they can get back some of these 4 billion. So when questioned about it, the management just said that operationally REITco is still doing well and they should look to divest within the next 12 to 18 months. The other asset they sold was some Saigon property assets, about 400 million. That should be recognized next quarter or next year. And the third is the Keppel data centers that they can sell. As mentioned before, the data centers is really hot, especially in Singapore because of the shortage of data centers. The other positive we got is that demand is still healthy in Singapore, especially green demand. So only, I think a few days ago, the authorities actually mentioned that power demand or electricity demand is in Singapore expected to go 3 to 5%. So 3 to 5% is huge. I mean, usually Singapore power electricity only grow only 1 or 2%. So this is positive, of course, for the whole power sector, but it's especially positive for green power, because for green power, what Keppel is doing is they're going to import power from other countries, and imported green power, that means it's solar power or hydrogen type. I mean, imported probably solar and renewable type power that can command a premium, because the carbon tax in Singapore has just jumped 9 times. So if you have green, you can avoid the carbon tax. And in only end of last month, I think the Singapore government mentioned that they're going to raise the amount of imported power. So from 4 gigawatts to 6 gigawatts. And so 1/3 of Singapore power in future or electricity will come from imported. So there'll be this long cable from Australia, from Laos or even from Malaysia. Keppel is tapped on it because they have 200 megawatts now and another 300 coming up. The negative is of course, real estate, and the commentary is basically, China real estate still needs time, so we don't see any turnaround in that. The other negative is, and also positive or negative for StarHub, is that there's a spectrum payment coming up. So if you recall in 2017, this is a long time ago, when all the telcos were bidding for 4G, they were bidding for this 700 megahertz spectrum. So they weren't awarded, but they still have to pay because this was a bidding activity. So now they have to pay by middle of next year, $188 million. I wouldn't call this flushing down the toilet, because there's really no use for this. I mean, they're more than enough bandwidth. Of course, they probably say that there's a use for it. But I think for 188 million, I don't think there's much congestion in some of the bandwidth now. So it's going to be a negative because they have to make this payment. So in terms of outlook, there's no change in our forecast, no change in the target price. The short-term catalyst we're looking for is the asset monetization. So they have a target of 10 to 12 billion to 2026. So they have another 4 to 6 billion to dispose by 2026, which they have not changed that guidance. So as the title suggests, we are much more positive on Keppel after this update, because there's this huge demand, like we mentioned, this huge wave of data center, and that's giving Keppel a huge tailwind recently. So firstly, they mentioned that around 10 billion of funds are now available that they can actually start greenfield data centers. So there's money, and that's part of their transition. They want to have assets under management, not use their balance sheet. So how this 10 billion come about is that they have a fund of 3 billion, another 3 billion from co-investors, that means people who don't want to put in the fund but can invest directly in projects, and another 3 billion for leverage. So why this 10 billion is important? Because it's part of their plan to grow recurrent. So assuming you take 10 billion, you build a new power plant, so Keppel can can benefit because they can earn no management fee. They can also earn from operation and maintenance of these data centers, which can be like 20-25 years. The other positive is this Bifrost. We don't really mention it, but what this is basically a submarine cable that they are building from Singapore to the US. They just mentioned that the first time they priced it, the pricing continues to surge because in part, I guess, is due to the demand for data centers. So the pricing has doubled since the first pair they did. So pricing is very strong, and this is another area where another asset monetization that they can work on. The third, like we mentioned, imported green power would more than double for them, which is 200 megawatts to 600 megawatts. So when you have green power or renewable power, you will command a premium because if not, you got to pay the huge carbon tax. And finally, they have the commercialization, because as you know, the demand, there's a shortage of data centers in Singapore. So they have two in Genting Lane. One already completed, the other is underway. And once that's completed, they have an opportunity to divest and get a gain for it and still make money from it because, you still have to do the operation and maintenance. Next slide. So in terms of, I'll just run through our usual weekly. So the main macro news that came out from Singapore was URA's third quarter stats. There's usually two parts, one on residential property and the other mainly on commercial, office. I won't run through that. I think Darren will probably do that on the third quarter REIT update. But for property, just give you some flavor of what happened in the third quarter for residential. So for new home sales, it's still down 40%. I think there's no surprise for us, but I think the new recent launches that's happened in October, I think we're definitely going to get a bounce from that. Secondary, one good thing is that secondary transactions has done very well. It's up 30%. So in total, I guess for PropNext basis, they want to look at total transactions. It's still up. It actually recovered from second quarter decline, is up about 3%. But first new launches have slightly better margins, but it's still an improvement. The volumes are picking up. In terms of the inventory, one thing good is that the Singapore inventory is generally stabilizing or slightly coming down. So this is inventory means of units that know that their land has been bought, whether you get the planning approval, not planning approval, but this is inventory that it will eventually be launched in the market. But the negative part is that because sales has been so weak, if you take this inventory divide by the annual sales of 4,000, you're getting like 5 years of inventory to be sold. Which is almost which is compared to the average of roughly 3 years. But I'll discuss it later, why we think this is not such a negative thing. But in terms of prices, it started to, at least the official property price is starting to come off. This is the first decline in 5 years. So this is, I will explain later again. Other things is just industrial production, which improve. And also for the US, we have some new orders. But in general, US economy, based on these two latest data points, is still generally stable and still healthy, the US economy. No signs of any recession. Next slide. Yeah, okay, I'll move on to our tactical view. So having attended almost 2 weeks of REIT results, listening into everything, I'll just give you some flavor of at least my thoughts. Firstly, the best sectors is the positives is Singapore data centers. So that's because of a shortage of supply. Like Keppel DC mentioned, they got 40%, which is a stupendous amount. I mean, you can raise your rent by 40%. Then their next one, I think, is Singapore office, which is a high single-digit growth even next year. So Singapore office, because supply is well absorbed and it's costly to move. The new IOI has been well absorbed, and if you want, the ironic thing is that under such weak economic conditions, existing tenant don't want to shift, because if you want to move, you have to pay for renovation. So most are staying put, and that's a positive for actually Singapore office. The third surprise for me has been Singapore retail is still resilient, because if you look at tenant sales, Singapore retail sales is contracting, or at most Singapore retail sales only growing 1%. So how can they still raise rent? I mean, so one way to do it is to raise occupancy costs, which is another way of saying I just squeeze the tenant more. Another thing is, don't ask me why, but there's still a lot of new retailers coming to Singapore with new retail concepts. So I guess like a fashion show, there's always new fashion. So that, of course, always helps the retailers, the malls. And the third thing is there's limited supply in Singapore. There's hardly any new supply. And also one area that is doing well is a lot of them are shifting to wellness and entertainment, where seems to be better consumer spending. But the main positive, I think, for 2025 will be the interest rate. So interest rates have peaked. No, you don't need the Fed to cut rates, but even without cutting rates, interest rates, if you look at all the results, most of them are guiding at most maybe 15 basis points or 20 basis points increase in interest rates. 15 basis points means 0.15 increase or 0.2% increase in interest rates. But in 2024, the interest rates jumped almost 1 percentage point or 1.5. So 2024 was very hard for the REITs to grow the DPU because interest expense can grow, 15%, 20%. So how can you outrun the interest expense? So next year will be better because it's more or less stabilized. Some of the negatives is logistics China. So like Mapletree Logistics mentioned that their tier 2 is negative 13-14%. If I'm not mistaken, this is the second year. So in 2 years, their rent actually dropped by 30%. So that is one of the worst markets. The second worst market, I think probably not that well flagged, is actually Sydney and Melbourne office. So Sydney and Melbourne office, if you thought US office was bad, I think Melbourne is probably up there, if not worse than some of the US cities. So the vacancy in Melbourne office is 20%. US gateway city is about 17. So I think maybe Melbourne is even worse. I'm not sure if it's an MPL problem, but one of the worst markets to be is Australia office. US office is improving because I think like Keppel Corp Pacific Core, I know there is a bit more confidence because there's no recession in the US, and of course work from home is becoming less. But the issues for US office is there's still high capex. So if you want to take a new tenant, you better build something new, and even the existing tenant will of course ask for something. You either improve the renovation of my building or you give me some tenant incentive. So that's still tough, and there's virtually no bank borrowings for acquisitions. You want to buy anything, you better just come out all cash, otherwise you don't have to buy any office property because the banks are not lending. For Singapore hospitality, we are a bit more cautious. I think the feedback has been, because of the revenge travel last year, this year will be slower, and next year will be tough because Indonesian and Chinese tourists are finding Singapore expensive. And there's also lighter calendar. I think we can't replace Taylor Swift first quarter and Coldplay. So we think hospitality should be softer next year, and there's a lack of events coming up. And also there's a clashing of F1 and Golden Week. I'm not sure whose idea was it, but you clash two together, then you get the Chinese tourists won't come because it becomes more expensive to come to Singapore. Some of the events coming up, if a lot of results, just for your reference, and the main macro will be the US PCE and also payroll number, and of course there's also Wilmar's results. These are some of the events. The C last year is actually mainly for TRs. Okay, next slide. I'll just move on to just to give you some illustration of the transactions. So these transactions, secondary market has picked up very strongly, the red line, and the new, of course, is down. It's probably some new low. The blue line has never been so low. So this is transactions by quarterly from URA. The one on the right is so one thing that gives me comfort is that the reason why new home sales has been down is coincide with the lack of new launch. So if you look at the table on the chart on the right, there's hardly any new launch. You can't even see it on the chart. It's so low, like minus 4,000 launches. So on average, you're talking about 10,000 launches a year. So over the last 12 months, only 4,000. And that's contributing. So the more worrying thing is that if you got a lot of launches and new home sales don't sell, then you have a problem. So we think like what we saw in October, that the new home sales should start to improve, and this should help prop next. Next slide. So this is just to show the inventory. So thankfully, the blue line isn't increasing. I think the developers are all cautious, especially when you see the red line. So red line basically how many years it takes to sell the existing inventory of 20,000. So this so the blue line thankfully is not really rising much. So it's just quite stable. The one on the right is basically property prices in Singapore. I guess the one observation is that usually after a cooling measure, you notice those really gray line that I put. These are usually the intervention, the raise ABSD, all those. So usually then there's where the line will start to pause. So like the recent in April, the raise ABSD, then you notice the property price will pause. But this time round, the pause, there was no cooling measure, but the property price start to pause, I guess. So that's one observation. Next slide. This one just to show that US economy is still largely stable. The new orders, which is corporate spending, is starting to pick up a little bit, and there's healthy lending and liquidity. So especially from consumer credit. But again, we just use this as to check there's no major red flags. So no major red flags for the US economy. Next slide. Okay, thanks everyone. I think we can move on to Q&A. Thank you.
Thanks, Paul. I'll take a few questions. Yeah, so a few questions on Tesla here. Let me try to answer them. The first question is Tesla likely to be a one-hit wonder? So the short answer is it's likely for this year. I mean, we already have one quarter left, but I wouldn't expect, at least on the margin side and earnings side, I wouldn't expect the fourth quarter to be that significantly better compared to what we've had for most of this year. We do expect deliveries to be up slightly year on year, but overall, I think commentary from the call, when you look at the core EV business, is still a little bit sluggish. I mean, 6% growth in deliveries is nothing really to shout about. So it's just that because this year has been so bad so far, just fundamentally, I mean, last quarter earnings were down like 50% year on year. And a similar story for the first quarter. So I think it was just more of a the market had a really positive reaction to it. But I think as we enter the fourth quarter and we wait for earnings to come in about 3 months, we'll likely see a little bit of softness there. The second question is, hi Jonathan, do you think Tesla stock has overshot over the last few sessions? Yeah, so I think it's gone up like 30% in 2 days. Yeah, which is quite crazy. Yeah, I mean fundamentally, see when you're trading at 100 plus times forward PE, it's always going to be a little bit overbought, unless you're growing at 2x minimum, right? So yeah, short answer is yes. I think it's overshot quite a lot, given given actually the fundamentals, haven't really improved by 30% or more. The third question here is valuation of Tesla's Bitcoin holdings reflected in earnings, and how significant is it relative to its core EV business? Okay, so how it works is that their Bitcoin earnings, their Bitcoin holdings are actually just recorded as fair value. So I believe their latest 10Q fair value was 180 million. And if market value is over that, they don't record any gains. But if the market value is below that, then they record losses. So right now the market value of this is around 800. But when you look at it compared to its valuation, its market cap, 800 million, right now they are about 800 billion market cap. So it's like 0.1% of their market cap. So for now it's not really that significant because they actually sold off most of their Bitcoin holdings, about 75 or 80% of their Bitcoin holdings. I believe in 2022, if I'm not wrong. Yeah, so right now it's not really that big a part, and people don't really take that into consideration when actually valuing Tesla. Another question here: who is Tesla's biggest competitor in China? Yeah, it's BYD. It's a little bit when you compare BYD and Tesla, you're still got to be a little bit careful because BYD has their pure EV battery EVs, and then they also have their plug-in hybrids. But whenever they announce deliveries, they combine the two numbers. So deliveries for the last quarter was like 1 million plus. But then when you look at just the battery EVs, it's around 400 plus. So the battery EVs, which are their pure play EVs, the deliveries are fairly similar to to Tesla. So they're kind of quite close in terms of market share there. But if you just look at the overall company, PYD is just in terms of delivery, they deliver way more. I think I saw, yeah, a couple more questions that I handed to the rest of my colleagues. Is ASML a good buy now since the CEO said last week that 2026 will be a growth year? Or will the impact of China still be detrimental to the counter? So I don't think it's really a good buy right now still. I mean, commentary is still a lot of softness for next year. I mean, revenue growth is expected to be 20 to 25%, which is, good in normal times, but when you compare it to the rest of the semicons, it's really lagging a lot of not the equipment manufacturers, but a lot of the other players in the semicon industry. Then you wouldn't expect margins to expand that significantly because that's not really their business model. So right now, I think they're trading at about 27, 28 times for PE. So fairly valued, I think. Probably not really the best time to buy ASML, especially because they'll have some weakness from China or at least a negative revenue coming from China. And then generally, overall semicon industry hasn't, other than AI, hasn't really recovered fully. So yeah, it's more of a 2026 story, 2027. I mean, you can buy now and just hold it until that. Maybe it's really, then yeah, I guess it's not too bad. But definitely there's still could be a little bit more downside to go. There's a little bit more softness and commentary is a bit not so upbeat moving forward, at least for the last quarter of this year. Okay, last question here before I hand it to the rest of my colleagues. Hi, Jonathan. What's the impact to ARM and Qualcomm from the license cancellation? Yeah, so just some backstory is that basically ARM and Qualcomm, ARM is suing Qualcomm for some licensing agreements because of the acquisition that Qualcomm made a couple of years ago. I think they bought this company called Neo, something like that. Essentially, this company is they do the design architecture for Qualcomm's Orion CPUs that they put in their Snapdragon X Elite, which is the processor used in their AI PCs. So it's their first foray into AI PCs. It's actually what I'm trying to do is just shut that down. Now, Qualcomm obviously maintains that everything is done in fairness and is in line with their existing agreements with ARM. But no one really knows what the outcome will be, I think. And overall, the impact is just negative to both companies because it's just really overhang, just a lot more uncertainty that both companies don't really need. Yeah, so nobody's really going to come out. As long as this keeps going on, no one's really going to be a winner per se. Yeah, I mean, if ARM wins, then it'll be quite detrimental to Qualcomm because they won't be able to put out their. They'll probably have to do some changes for their Snapdragon Elite CPU, and that's kind of their big selling point with their new foray into AI PCs. Yeah, but until then, just be a more of an overhang to both stock price, and you've basically seen that, well, at least on the Qualcomm side, you've seen it. Yeah, I think maybe no more questions from me. I hand it back to the rest of my colleagues. Thank you.
I think I'll take over. Before I start, we apologize. Actually, Zain is on leave today, so there will be no TA session. Okay, so one of the questions I have is Apple Intelligence beta is out. Will we see a boost to the share price soon? Likely not, because right now it's very limited rollout. The country that actually roll out is only the certain English-speaking country. So if you're not in the country, you can still change your Apple Store account into the selected support countries in order to try to use it. But that doesn't apply for the China residents. So if your iPhone was purchased in China, no matter what store you switch it to, you're not going to be able to use the Apple Intelligence. So right now, only certain features roll out. The major smart Siri is not out yet. They only roll out the text-related ones. You can proofread your messages, change it to a different tone, be it professional or friendly. They also have the glowing animation. But there has been feedback that because it's beta version, so some of the features are not really doing well. They also came up with the Apple Cleanup, which is similar to Google's Magic Eraser for photo editing. So they say the feedback was it was rolled out way after Google, but the effect was not as good. They also complained that the battery draining was quite a big problem. So basically, if you use the Apple Intelligence for only 1 hour, it's going to drain around 50% of your battery. So right now the feedback pretty mixed and not so positive. And Apple itself, they already guided for the rest of the 2024. They expect pretty much flat or even negative iPhone revenue growth. So we're still gonna expect the full on upgrade to come in FY 25 and 26. So unlikely we're gonna see a spike in the share price. So I hope that answers your question. I guess that's pretty much for me. I'll pass to the rest of my colleagues. Thanks.
Let me take on some. Hi, can you comment on Mapletree Pan Asia Commercial Trust fundamental and technicals? Yeah, so like Karina mentioned, Zain is on leave, so there will not be any technicals for today. Yeah, but for Mapletree Pan Asia Commercial Trust, their Singapore asset like VivoCity and MBCs remain rather resilient, but the weakness for them is basically everywhere else, every other country for them. So we saw some negative reversions for their Festival Walk property in Hong Kong, China properties, Japan properties, as well as the Korea properties. Yeah, and they also the weakness is there's some weakness in Japan because of some tenant vacating. So as a result, they also did interim portfolio valuation, and the valuations were hurt by quite significant amount, like double-digit negative. Yeah, and China reversions also remain weak. So Mapletree Pan Asia Trust, the outlook for Singapore is strong, but it's because of the weakness in the other countries. It's kind of a mixed bag for them. Yeah, so because Singapore remains strong, the other properties remains weak. Yeah, so that is the outlook I have for Mapletree Pan Asia. Please comment on the rights issue of ESR Logos REIT. The rights issue price is higher than the share price now. Yeah, so I believe the share price now is 28 cents. The rights issue is about 30 cents. Yeah, so but for ESR Logos, basically the sponsor has already fully committed to underwrite the shares. So even if nobody takes up, basically, because the rights issue price is already over the current share price, so most logical investors will not take up the rights issue. So when they do not take up, then the sponsor will fully underwrite the amount that is 94 million. Yeah, so that is the situation there. The sponsor is fully committed to take on the share, like fully commit to the rights issue. Is Escort looking to divest more? Yeah, so because of this current interest rate climate, interest rates are coming down. Definitely more capital recycling activities will happen. So yes, I believe so. Escort definitely looking to acquire and divest more as well. For data center REITs, Keppel DC digital coverage, a better buy. Yeah, so both have their good and bad points. Keppel DC you cover, but digital core we don't cover, so we do not have a fundamental say. But like Paul mentioned, Keppel DC's data center space now is like the strongest point in REITs. Like we see a very strong rental reversions for both Keppel DC as well as digital core. Yeah, yeah, but because we don't cover digital core, so we can't really comment on whether it's a good buy or not. Yeah. FCT is a higher tenant sales versus pre-COVID contributed by F&B or non-F&B tenants. And what is the percentage of F&B tenants in FCT NLA now? Does F&B tenants command higher rents as compared to non-F&B tenants? Yeah, so this is actually a good question. So pre-COVID, and now the percentage of the portfolio NLA to F&B, like 2019 versus now, is about the same, 30%. And it, based on this 30% contribution, F&B as a percentage of the net lettable area, this 30% accounts for about 38% of the GRI, the gross rental income. So basically, you can say you can't really generalize because it's different. There are different trade categories. Some command higher rents, way higher rents. But in general, as a percentage of portfolio, yes, F&B tenants does command higher rents as compared to non-F&B tenants. So you can actually take a look at the trade mix. It's inside the it's inside the investor relations slides. So on an annual report as well, you can see the trade categories, and they classify it as a percentage of NLA and as a percentage of total GRI, gross rental income. So basically, you see if the percentage of NLA is, let's say, 30%, and as a percentage of GRI is 37%, basically that means that the food and beverage sector commands higher rents as compared to the rest of the portfolio. But some other notable subsectors that command higher rents is also watches and jewelry. Like it only takes about 1% of the total NLA, but it contributes about 2.6% of GRI. And the weak one is supermarkets and groceries, where it takes up about 11% of the portfolio NLA, and it only contributes about 6% of the GRI. Yeah, so I hope that answers that question. Has MLT's issue with China tenant resolved? So basically MLT, their rental reversions are still weak, like I mentioned in the presentation. So we expect another 2 quarters of double-digit negative reversions, and it's likely to improve thereafter. But that's mainly because most of their leases are already marked to the market, which is quite low already. Yeah. Why CapitaLand Ascender Street share price dropped quite significantly? What is the outlook and PP? Yeah, we don't cover Ascenders, so we do not have TP. And Zane is on leave, so we can't really do the technicals for that either. But for outlook of CapitaLand Ascender Street is that we believe generally the rents for starting to slow, especially the business parks. Like used to, like the logistics space also used to be higher double digit, but we think it will slow to the single digit levels. So rents are starting to slow, and consider like the share price movement dropping quite significantly over the past month, 289 to current 273. I think that is more in line with the rest of the market. So the market is also, after the very sharp rebound, like maybe that the rally was too fast already. It rallied like 15% in 3 months. So since then, it has pulled back quite a bit. Yeah, so I think that is more market sentiment, and not so much the share micro, not so much Ascender Street per se. It's more of the overall market and like the interest rate calls and such, the interest rate cuts outlook and such. Yeah, that's what I meant. Yeah, another question also similar. The REITs have come down from initial euphoria of rate cut. This is due to the moderate outlook of rate cut and pricing in a possible Trump win. What to expect next? Yeah, so for REITs, we are still expecting DPU growth next year because of the rate cuts, and a lot of the REITs, like most of the REITs, are forecasting very marginal, at most slight increase in interest rates next year. And a lot of REITs are also forecasting lower interest rates as their interest rate swaps have already been marked to market. So it's kind of a mixed bag for the REITs, but generally we see most REITs either flat or lower interest rates by next year. So that will definitely help to improve the DPU for REITs, and as a result, the yield will be higher. So yeah, we are still positive on REITs for now. Yeah, please comment ESR logos right issue. Yeah, I already commented. Thanks. Yeah, view on Mapletree Pen user also commented. Yeah, I think I'll hand over to my colleagues. Thanks.
Yeah, thank you, Darren. I'll take over the SaaS question. Do you expect the result for SaaS to be good? Any target price for SaaS? Yeah, so we have a buy recommendation for SaaS with a target price of $4.37. So we expect FY25 earnings to be good, increased by 8% year-on-year, supported by the various contract repricing and increasing cargo demand. So SaaS has successfully repriced the contract with one of its biggest customer, SIA, and accounted for revenue from SIA accounted for 17% of the FY24 revenue. So the new contract has already took effect from second quarter 25 onwards. And so we expect at least 5% rise, generating around 45 million revenue. Yeah, so therefore we do expect the next result, which is their second quarter 25 result to be exceptional, since contract repricing will be taken account. And SIA is also capitalizing on the recovery tailwind of the airline industry and also spillover effect from the Red Sea conflicts. Yeah, so because of the Red Sea conflict, the time-sensitive products has been redirected from the sea into the air. Yeah, so as a result, air cargo volume increased by 19% year-on-year in first quarter 25. And we do expect the air cargo demand will continue to stay strong. Yeah, so yeah, we are pretty positive on SaaS. And the surge in share price last Friday was we believe was because CITIC just revised their target price upwards from 3.76 to 4.25. Yeah, so essentially they're also pretty positive on SaaS upcoming result. Yeah, so the share price rallied. And there's a question for Suntec. Yeah, so basically, for Suntec REIT, will their Singapore property better performance able to offset the poor performance of their Melbourne asset? And what's the outlook in 2025? Yeah, so we do believe the strong Singapore performance will offset the weakness in overseas asset. Since Singapore asset income from Singapore accounted for around 70% of the total income. And overall, we expect revenue to increase by 8%, but DPU will drop by 15% year-on-year due to lower NPI margin and increasing financing cost. Yeah, so performance in UK is likely to be flattish, with pretty stable supply and demand, and also incentive. Yeah, so 2025 outlook is positive. Once Bank of England cut their interest rate more aggressively. And the drag will still come from the 17% income from Australia. As mentioned, vacancy rate for Melbourne remains high, and it's even worse than the US gateway cities. And also incentives is around 35% to 45%. And supply continue to enter into the market, and employees doesn't really want to go back to office. Yeah, so there won't be any expansionary demand. Instead, like corporates will continue to consider cutting space. Yeah, so just continue to be weak in 2025. Yeah, Singapore remains strong, undoubtedly, and undoubtedly will soften from its peak, from the current high. But rental reversion for retail is still expected to be around 10 to 15%, and office will be around high single digit for the rental reversion. That's all for me. I'll hand over to Paul, maybe. Thank you.
Yeah, thanks, Miriam. Let me just move on to some. What's the impact of Q&M news this morning? The impact would be, I don't think it's material. So right now for that unit, for that unit that does the lab, so they're doing two parts to it. There is the lab test that they were working on. It's more a longer term project. They have to spend R&D, and the other part will be there's still COVID-19 testing and injection, but that's going to end in end 2020, end of this year. So the impact won't be much for next year. And anyway, the contract is going to end anyway. So I think this is just to carve off the likelihood of any kind of losses that they can get from continuing this business. Acumen, sorry, to slip my mind. Yes, so Acumen has two parts. They were trying to do this long-term project of building using the test kits to test all kinds of disease. But I think probably Q&A had to spend more, so they decided not to continue with this. So I think it's probably neutral, this impact. I think it's just to carve off any likelihood of losses, because once the testing and injection business ends, the contract ends this year, I think this company could swing to losses without that part of the revenue. Can we expect more contracts from Seatrium? They've got 100 million contracts. Yeah, there's apparently one more contract coming up from Petrobras. If you read the news, I think they are planning to issue one more. There should be one more FPSO apparently coming up by this year. Yeah. Hi, Grand Bank announced strong business update last week. Any views from Phillip Research? Possible to initiate research coverage, invite company? Yeah, we did ask them for through their IR. We did ask them whether they want to do webinar. They just say no. Yeah, we were trying a few times already, but they just say no. Yeah, but if you look at the update, there's no analyst briefing also. If you look at the update, their order book is actually down 30% for what it's worth, although the earnings is strong. But if you're an order book business, then I think the most important is order book. So your order book is down 30% year on year. We're not saying the earnings will come down, but I think the order book usually takes 2 years to execute. So even if you get anything now, you're not going to execute it for the next 2 years. So so that's the only comment we have, since we can't get to meet management. Is Genting results likely to be weak following MBS weak results? So MBS results was actually mixed. I wouldn't say it's weak. The one thing good is that their mass market, mass market is those who go slot machines, go mass table, that actually still growing at about 17%. But the one that hurt them is the rolling chip. So rolling chip is the VIP segment. They don't give the exact revenue, but rolling chip means the amount, those for VIPs, they will bring money in and they will get this special VIP chip. So that's what they disclose. So that is actually down quite significantly, from 8 billion to 6 billion, but it was really unusually high last year. So in general, the earnings were basically flat. So I think the takeaway for Genting is probably mass market will still do well. So in a way, the earnings quality is better because mass market is less volatile. But I think the VIP market won't give you the growth anymore. I mean, that's already done, and it's probably on a declining trend if you look at the VIP rolling chip. So in a nutshell, for Genting, I don't expect earnings to drop. I think if you use MBS, it's probably will still grow, but it will be slow growth from now onwards. I think you probably won't see much more strong growth from Genting from then. But yeah, because you're like running on only the mass market to grow, and the rolling chip or the VIP segment is contracting. So it's sluggish growth, I guess, from next year onwards. Yeah. Why they all drop? after Israel retaliation, should we still hedge? I think I think the reason it dropped was because I think we all saw the news. I think Iran said that they should not respond too aggressively. Neither should they respond I guess, yeah. So it's in a nutshell, Iran basically said it's going to be a muted response after Israel attack. And the second thing is Israel didn't attack any of the oil facilities. They just attack all the defenses. They didn't attack any civilian targets. So again, also from Israel, they also exercise restraint. Yeah. So should we still hedge? I don't know. But like the reason we do it is just to hedge. So if it was just, it's like buying insurance. If the worst case did happen, then the hedge will work. So this time around it didn't. But for me, I always find there's always a need to hedge against all these Middle East all these Middle East issues. Suntec, I won't leave it to. Sorry, there's a lot of technical questions, so apologize. Zin is not here; he's on leave today. We should inform you earlier. So sorry for everyone who posed a question and no, we won't be able to answer for you. Apologize for that. Keppel mentioned tailwind on data center. Does that specifically mean data centers in Keppel DC or data centers? So what I was referring to is more when new data centers are being built, that will help Keppel. And if you have greenfield data centers, so how data centers will help Keppel now in general. So if you assume Singapore, there's going to be a lot of data centers, or the demand for data centers in Singapore and regionally is going to grow. So Keppel will benefit, number one, because they managed to set up new funds. So there's a lot of money on the sidelines that want to work with Keppel to build more data centers. And they want to work with Keppel because they have the expertise. Yeah. So that's number one. Number two, the submarine cable will do well because if you assume more and more data centers are coming up in Malaysia and coming up in Singapore, the most important is the connectivity, right? So it's like, I'm just kidding here. It's like watching Netflix. I mean, you might have the data center, but you don't have the connectivity, then it will still affect the cloud connection or the user experience. The third thing that's benefiting is the power. So when you have data centers, it also means more power. So actually, very surprised that Singapore raised their electricity forecast to say that it's going to grow 3 to 5%. So again, they won't tell you which segment, but I guess data centers is one of the key things. Yeah. So these are the three main areas. It gives Keppel more money. It helps them. There'll be more power for demand and be more power for the submarine cables. And the fourth thing is that because they have two data centers that is just completed, the timing is I guess excellent. I mean, you have 2 data centers now when the demand is just insatiable, especially with AI. What's your view of First Resources and OLAM going forward? Will the surge in commodity prices benefit them in any way? For OLAM, it's really hard to isolate because they got so many business. And also, like all of these trading companies, it also depends on their ability to hedge, or I guess timely purchases and sales. I mean, I'm not sure that's the best way to say proprietary trading, but I guess timely purchase and sales. Or for cocoa, it's probably better if you have like all these JB foods and all that. They are the real cocoa processing, and higher cocoa prices actually help their spreads. For First Resources, I think they will also benefit from the higher palm oil price, and also, like we highlighted before, the lower excise duty. You won't see in this quarter. You probably might see in the fourth quarter, but I think there's definitely a benefit for them. The lower excise duty for Indonesian exporters, or palm oil producers. What's the outlook for Singapore performance, US and Singapore banks? Okay, so I'll leave it to Glenn. Okay, I'll answer this last one. This last two, then I hand it to Glenn and Darren too, and Meow Meow. Hi Paul, can you repeat the salient points for PropNext going forward? I missed that part. Okay, so for PropNext, firstly, we like PropNext because they have a huge market share, like 40 to 50% market share in new home sales, and also for resale. And buying any company, especially in Singapore, otherwise it'll be the GLCs, right? That have actually such a huge market share in any particular industry. So then number two, we like it because they are quite good in returning capital to investors. So my own view, they always target for like a 6% yield kind of. And next year will be the 25th anniversary, so we should expect some special dividend, my own guess. And then number three, new home sales, we think is starting to bottom up. New home sales, it doesn't mean it's not healthy. Of course, prices are high, but also means that because there's not enough launches, so that's why that's expected. And I think the last few weeks, we've seen a lot of new ventures, and that will create momentum for them. By the way, we will have a webinar with them. I think they do go to the Points website. Yeah, you can. It's open to anyone. You can register for that. Yeah, I hope I answered that part for you. Now let me do one last one before I hand over to the rest. If Trump wins, how will it affect tariffs for Singapore companies? If he wins, one scenario would be he would raise tariffs on all countries. If you assume ASEAN and all that, so Malaysia will be the most impactful for us. But having said that, there might be a knee-jerk reaction. But also remember that if all your competitors also have higher tariffs, it doesn't mean anything. All it means is that the customer in the US has to pay for it. So it doesn't mean the Singapore companies will lose market share because the competitor China get hit more. So actually, it might benefit them more. It may only mean it might make the customer want to source more it might source more internally from US, but I don't think so because of the costly. And the second thing is that there might be an impact on currencies. I think if the news comes out, 60% of China, so China currency might get a hit. And of course, our currency also will get a hit. And that kind of equalize. I mean, if you want to go and build anything in the US, it also means it become more expensive because the Asian currencies are weak. But weak Asian currencies will impact the fund flows into this region. So, but net, I don't. There will be a knee-jerk reaction, I think, but the Singapore companies affected are the contract manufacturers. We are talking all venture. Everybody, I think venture. AEM, you just pick any Singapore Franken, because everybody has a plant in Malaysia. Yeah, I mean, everybody has a plant in Malaysia to take advantage of the currency and the lower wage. So that's how it affects. Yeah. The only Singapore company that has a pure US exposure is probably CSE. So CSE, if they do more investments, yeah, that's the only one I can think of that has a pure US exposure. Yeah. Okay, yeah, thanks. I'll move on. Let the rest take the rest.
Yeah, thanks, Paul. Yeah, so just got back from I just ended the iFAST webinar. So, I'll just take the first question here. So I'm just looking at my phone to see the questions. Is iFAST expensive in terms of valuation? Stock good fundamentals, but can't break new highs. Yeah, I think you're right in terms of valuations. It's rather high, right? If you look at their PE ratio, I think it's around 40, above 40, compared to their. If you look at their comparables, it's like 20 to 30. So it's a bit on the high side. But yes, you're right that they do have good fundamentals. So another question also was asking, what are the updates from iFAST? Basically, it's pretty similar to the previous quarter. They're just seeing, that we really try to ask what is growing this AUA and this net inflows. Is there any specific reason? But all they're saying is that it's due to the improving market conditions, and then again they refer back to their past, right, and the average, and it seems like it just tags along to the how the market is doing. So that's why there's this like improvement in their inflows and ultimately their AUA, which will also affect their core business, which is the wealth management business that they have, right, and they're able to get better margins. I think some key highlights which I didn't really talk about earlier was that their guidance is for Hong Kong, the e-pension side will be slightly higher, I think, than what they have guided. They haven't changed the guidance officially, but currently I think it's coming in around just above 200 million Hong Kong dollars for 9 months 2024, and they're guiding for 250 million for profit before tax. So they are also expecting it, and I think that it will probably come in above that 250 mark. So we could see some uplift from the guidance there.
Apart from that, they are global bank, which is what they have been talking about majority of the time now. I think they are still trying to expand the global bank. So break even, it's still maintained at the fourth quarter of this year, but I don't think it'll be quite hard. I think they might miss it by a little bit. And they also did not want to talk much about how much profit this will generate for 2025. They're a bit cautious. I can understand why, because they are still trying to expand. If you look at their spread or their NIMs from this bank, it's only around 1% now. So it's really quite low, because they have no choice, because they need to get as many new deposits as possible. I think the one big positive from the global bank that I can see is that majority of their customers, or the new customers, new deposits that are coming in, are actually non-iFAST customers. So they're able to cross-sell to them, basically. Like they're getting these new customers and then push them to their wealth management platform, which is also probably why we see this uptick in AUA. Yep, so that's for the iFAST. Let me just go back to the questions to see this. I think there's more about the banks. Give me a minute. Let me just go through. What is the outlook performance of the US and Singapore bank stocks with high possibility of Trump win? I would say maybe, yeah. So if Trump wins, there are a few factors that could affect the banks, right? Firstly, the regulatory changes. I think the new Basel increased capital requirements are sort of limiting the banks. So so now, in a nutshell, what they're trying to do is that the new requirements are requiring the bank to hold more capital, right, in reserve. So if Trump really wins, and if he cuts back on this, then this might lower the amount of capital that they have to hold back, which could positively allow them to use capital more effectively and use more of their capital. So this could boost their profits. And another thing, I think the biggest one would be the interest rate. So if Trump wins, his policies might result in a steeper yield curve, so that could benefit the banks, where they are able to put a lot of their excess deposits into higher long-term rates, and lower their cost of funds, right? So that's the main thing, and this could potentially increase their interest margins. And I think the last one, it would be, he might also lower some of the corporate tax, so that could be another factor, but I think that will be really quite minimal. Yeah. So I think for the banks, in any bank, regardless of who wins, right, I think their core fundamental business model has to be good, firstly, which is what will allow them to win, what will allow them to grow despite which president wins or any political decisions. Yeah. So I think that's more important than actually who really wins, for the banks at least. Okay, one more interesting one here. Which is the best Singapore bank now? I don't think for us, we don't say which is the best Singapore bank. So I would say that our favorite bank now would, at least of now, would be UOB. Just a few points why we believe so. Firstly, UOB has quite a large number of high cost fixed deposits, which they haven't repriced downwards yet. So this could benefit them and further lower their cost of funds. And also another factor that could lower their cost of funds would be that they have the highest, I think their CASA cost of funding was the highest. If you bank with a Singapore bank, you'll know that the UOB One account was very well known for giving the best rates, right? So this could possibly be another factor where they could further cut. They were the first to cut, right? And I think they're the only ones to really cut their flagship current account rates, and that have actually flowed through to their cost of funds and their deposit funding. So this could further lower if they cut again, and they'll still be on parity with the other two local banks, right? Even if they cut, so it's not like they're going to lose deposits. And also, if they reprice down the fixed deposits, that could also further improve their net interest margins. And secondly, we also feel that they are shifting away from the sort of like the traditional way of banking, where you just take in deposits and lend out money, right? Because that margin has been being more and more compressed. So the UOB is now realizing that they need to shift away from that. So they're focusing a lot on their fee income growth, and their recent acquisition with Citibank has also allowed them to accelerate their growth by around 3 to 5 years. So otherwise, this would have taken them upwards of 5 years to reach this stage where they are at now. And the last one is that they're also rapidly growing into other areas outside of Singapore, because Singapore is quite saturated, so there's not much growth here in terms of loans, in terms of fee income. So now they're moving away into the, I would say, the developing countries in our region, and that's allowing them to further grow their fee income. So that's for the what is our favorite bank. Okay, I answered the one on iFAST. Okay, what's the fundamental take on JP Morgan? So for JP Morgan, I think that they are really a very diversified bank, right? So they have their arms in almost everything, right? Unlike if you see other banks, right, they usually try to focus on let's say one segment, and then they make it that's their specialty, right? You look at Wells Fargo, Bank of America, Goldman Sachs, right? All these banks, they focus on one thing, but JP Morgan, they focus on everything, but maybe due to their size, where they're able to focus on everything and do it quite well also. So, but that also could be a drawback for them, because what we're seeing is that they have been growing revenue in all their segments, but rather I would say a slower pace as compared to the rest, right? What we're seeing now is that their asset management, investment banking, across the board for all the banks have been doing well, but for JP Morgan, it makes up only a smaller portion of their total revenue and total profit. So this could potentially diminish their growth in their earnings as compared to, let's say, Bank of America, where they have a much larger portion in wealth management, asset management fees, right? So this could diminish their profits slightly, and also net interest income is coming down also, so that should it is very flat growth. So if they're not able to pivot away from the usual net interest income and go more into this fee income or non-interest income, then they could see this sort of a stagnation of their growth. But so far, at least for this year, we are seeing that they are still able to grow revenue and their profits in all of their segments. So it could possibly be another strong year for them, but next year could be a bit of a they probably couldn't go as strong as the other banks out there who are more focused in what they are doing. Let me see whether I have any more. Oh, okay, yeah, one more here. Will banks benefit from drop in interest rates? Very broad-based question, but the answer is yes and no, right? So yes, why? Yes, because if the interest rates drop, the market activities will pick up, and then they'll benefit from their fee income or non-interest income, right? Basically their asset management fees, their wealth management fees, all these will continue to increase, because if the interest rates drop, they are not putting it into lower margin products like fixed deposits. So now the investors are shifting, and investor sentiment is shifting away from that into wealth management products, which the bank can earn a lot more, right? So that's the yes portion, where we can see their non-interest income improving, and we have seen it grow by double digits for any bank, right? Regardless, the US bank and Singapore bank both. But no, because net interest margins will be I think will be quite compressed going ahead. Although cost of funds will ease up, what will happen is that their loan yields will also decline, right? And whether or not the cost of funds decline will sort of more than offset the loan yields decline, and also whether or not loans growth can offset this sort of loan yields decline is hard to say. I think it'll be very flat, right? So we'll see net interest income actually ending up at a rather flat position. So in that sense, it's a no. Overall, I still think it could be a positive for the banks, because we have seen net interest income actually flatlining, even though rates were very high. I think it was too high for too long, which is the higher for longer sort of backfired for the banks, where they saw that suddenly we have this huge increase in net interest income and net interest margins, but it petered off because they couldn't increase loan yields anymore, but cost of funds was slowly creeping up, which is why they saw the stagnation in net interest income. And also to sort of make that even worse, exacerbated, would be the loans growth suddenly dipped down, right? It was like mid-single digit, now it's low single digit. So all these factors going in actually caused their net interest income to be flat, right? So maybe a sort of a slow decline in the interest rates could benefit the banks, because we will see better loans growth firstly, and then also non-interest income is growing. Yep, so that's the short answer. That's the answer for that. Let me see whether there's any more here. Yeah, I think I think that's all for me. Yeah, that's all for me. I will hand it over to the rest of my colleagues. Thank you.
Which REIT company has Australia office assets? Yeah, so Keppel REIT has, Suntec also has. Yeah, from the top of my head, yeah, these two. Any update on tourism in Singapore? Has it picked up? Yeah, so tourism, the international visitor arrivals definitely is improving year on year. We expect it to recover to pre-COVID levels by next year, but the issue for this is that we notice a lot of the trend of downtrading, where a lot of tourists are spending less as compared to pre-COVID levels. So that is might be an issue. We are monitoring the situation, but yeah, but definitely the absolute numbers of international visitor arrivals has been improving. Yeah, but the total spending as a whole, yeah, might not be improving as much as the increase in the total international visitor arrivals, because basically they are spending less in Singapore tourism, tourists rather. And what is the rental reversion rate in the central and other districts in the recent quarter? Yeah, so for basically for suburban malls, the rents are around high single digits for the retail sector, and for in the central area is upwards of 15% to low 20%. Yeah. So that's so far from the recent quarter. How many percent of portfolio of Keppel DC is in Singapore? Yeah, so it's about 55% of the portfolio of Keppel DC in Singapore. Is data center in other countries doing well? Really depends. Like they have one data center that is the Gore Hill data center, about 3% of the total gross rental income. The tenant is has vacated. So we are monitoring to see when will be able to release that space and at what rental rates. So that is for the Australia side data center. China is the tenant is still not paying. Yeah, so from what I've noticed is basically the strongest market for data centers is in Singapore co-location space. Yeah, that's definite. As you saw, 40% reversions for 2 quarters already. What is the implication of ESR logos preferential offer higher than market price? Yeah, I mean the implication is just that if you are a shareholder, you definitely should not subscribe to the rights, because basically if in the market is 28 cents, the rights you're paying 30 cents. I mean, doesn't make sense at all to subscribe to the rights at all. Yeah, and the sponsor has already fully unwritten the excess rights that will not be taken up. So yeah. Why CLI prices weaken considerably? Any fundamental shift? Yeah, so I don't see any news, and yeah, I don't see any fundamental shift in it also. Yeah, but we are still positive on CLI, because we've seen them really increase their event-driven fees. Like especially this quarter, we expect quite a lot because from the divestments of Ion and this divestment of Ion and Life Funan. So definitely event-driven fees will pick up this year. Yeah, so we are really positive on CLI. Yeah, but no news why the price weakened recently. But one thing to note is that before, rather after their first half results, the share price really rallied from 250 to over $3. Yeah, that's all from me. I hand over to Felix. Thanks.
I'll answer the SIA question. Oh, why is SIA down over the last month? Yeah, so we believe it's trading on the result after September data comes out. So released by SIA. The group's passenger capacity increased by 9.7% from a year ago, and also it outpaced the growth of passenger traffic of 7.7%. Yeah, so as a result, the group's passenger load factor coming at 1.6% percentage point lower year-on-year. So we do expect margin to trend down further for the upcoming result. Yeah, that's pretty much why we believe the share price was decreased. Yeah, I'll hand over to the rest of my colleagues. Thank you.
Answer the Indonesia block. Yes, they block iPhone 16 sales. I think because Apple promised the government they're gonna invest around 100 plus million US dollar, if I'm right, to boost the local content, etc. So they have been doing so, but they still fall short like 10 million or so. So Indonesia say now they're banning iPhone 16, but they're only banning the sales, which means a personal use is still okay. So you do see a lot of people trying to smuggle inside. I would say Indonesia itself is not a big market. They don't exactly disclose the number for Southeast Asia. They do disclose China, Japan, and the rest of Asia Pacific. So the rest of Asia Pacific altogether is only account for like 7% of their total sales. So unlikely to be big impact. And even if there is a bigger impact than expected, all they need to do is to pay up the remaining 10 million. So it shouldn't be a big effect overall. Yeah, that's pretty much it. I'll pass to remaining colleague.
Yeah, thanks. Thanks, Helena. I'll just move on to the rest. Is McDonald's a buy the dip after the equalize? I'm not sure whether it's a buy the dip, but I think it has been resolved. I think the so-called Big Mac is back on sale in the US. Sorry, we don't cover McDonald's, so I'm not sure how to give you an answer on the stock price. What's your view on CIVMAC fundamentally and technically? It's generally positive, but I haven't been meeting with them recently. So let me try and get an update from them before I try to answer you. But they've done well because there's a big capex cycle underway in Australia. Plus, I think they managed to penetrate the defense industry, but I haven't gotten any update. Let me try and get an update from them, then I will return to you. DU on NVIDIA and AMD, I'll leave it to John. In view of the cooling euphoria in AI, what's the impact on these few counters, namely Franken, UMS, Grand Venture? Yeah, okay. In general, the impact on AI has been positive, and I think it just started. For AEM, it's positive because they have a new AI customer. I guess that's most likely AMD. For Franken and Grand Venture, it benefited them because Teradyne is a customer, and Teradyne does tests for high bandwidth memory, which is related because of AI. There's a new growth in. So I think the euphoria is probably on the valuation side, but I think you've seen the share price of some of these Singapore tech names. I think there's no more euphoria there left. But I think fundamentally AI is still the big growth driver. I think like we saw in ASML. So AI is still going to be the biggest growth driver for all of them. Venture, no, because venture don't really have any direct AI. And AI is not just the chips, it's also the whole data center setup. So for venture, they are building some fiber connections for data centers, so they will also benefit. So I don't think it's not about the euphoria is probably on the valuations, but in terms of spending on AI, that still continues. Yeah. So that still remains a growth driver for them, either near term because of revenue higher, or also for new customers, which is more structurally positive. What's your thought of Keppel REIT co disposal status? Why it takes such a long period to find buyer with today REIT? it takes time. I think this whole deal was probably only in early 2023. And I think the recovery in REIT only happened in this year, so it will take time for this to happen. Yeah, but like what you said, I mean, the REIT rates continue to climb up, and there's no one else building any new REITs, so that's why it will take time. And this is a 4 billion portfolio, so we don't think they'll sell everything. We think they'll probably sell some of the REITs and then repay some of the vendor notes that they owe Keppel. Yeah. But all this takes time. I think the whole restructuring only took 1.5 years ago, slightly around 2 years, or maybe just slightly about to reach 2 years. This whole restructuring to happen. So this takes time. Yeah. But most important, the REIT rates continue to climb up. Yeah. Your latest update on Thomson Medical, any chance? Yeah, thanks for the idea. I think it didn't occur to me. Yeah, let me try and ask them for a webinar again. Sorry, sometimes I missed that part. Latest update. So I think because one of the key stories for Thomson is their land bank in Johor. So we're looking at the SEZ. As you know, there was the SEZ, details of the SEZ in Johor was supposed to be done in June or July, if I'm not mistaken. Then it has been pushed to year end. So that will be the thing to watch for Thomson Medical. Like what kind of news flow comes up from the SEZ. This one on Poem Street, I'll leave it to Glenn to answer. On this one, the TA, I apologize again. TA, Zane is not in, so we can't answer any TA questions. Yeah, thanks. Hand it over to Glenn and John.
Yeah. Yeah. So I maybe want to clarify how to key in trading questions after web meeting. You can just scan so you scan this QR code here. It will bring you to download our P3 app. So you can just sign up. It's free. It's a free account anyway. You just sign up for it and then you go into the community. Hold on, give me a minute. Let me bring it up. Yeah, under the bottom tab there, you can see this. If you look at this image here, it says community here. You just click community and then you join the community that you like. You'll be pre-joined into any community. So you just join a community and then you just type in your questions, whichever questions you have. And I think we'll answer your trading questions or even fundamental questions, yeah, into the relevant communities that you enter your question into. Yeah, if you don't know if you are still unsure, you can always drop me an email and I will try to guide you on how to enter the questions. Yeah, hope that helps. And hand it back to you, John. Thanks.
Yeah, thanks, Glenn. So I'll take this question. Any views on NVIDIA and AMD? I'll start with AMD first, since they are announcing earnings Wednesday morning. I think overall, when we look at AMD, obviously they're trying to market share on NVIDIA in the AI accelerator space. Not quite sure if that is actually happening, given there are still at least one generation behind in terms of technology. But that being said, when you look at the overall fundamentals, it's probably going to it looks to be improving. Obviously, AI is a big boost, but when you look at some of its other segments, especially like client or your PCs, CPU, GPU, server CPUs, are all doing well. The only drag that has been a drag for the last few years has been its other two segments. One is gaming, which is your console segment. And that's because there hasn't been any launches. PS5 was like 4 years ago, something like that. And so if there are no new launches, then that doesn't really drive volume for that segment. And then the last segment they have is their basically embedded segment, which is everything else. All your chips there, your washing machine, fridge, and that kind of thing. Obviously, because there's not really much volume there as well. So those are really the volume game for those two segments. But overall, we are fairly positive about AMD still. I think with the relatively new boost from AI, especially with their new MI3 to 5X chip, they should be able to take in some orders. Maybe not at the scale of NVIDIA, but definitely at least to boost overall fundamental financial health and growth. Then when we look at Nvidia, I think the growth story is still very much intact. I think every week or every few weeks you hear about AMD partnering with the Middle East, for example, like Dubai, Saudis, working with India, Japan, and working with a lot of government related entities to try and build up who want to build out their own AI data centers, and obviously they just want the best, right? Because they're all sovereign nations, they want NVIDIA GPUs. So we're seeing still a lot of demand flowing from obviously your hyperscalers, but outside of that, there's also more traction from sovereign nations and other enterprises. So overall for NVIDIA, the main thesis and the main story about dominating the AI accelerator space is still very much intact. I think when you look at the valuations right now, it may have gone up a little bit, probably like close to 40 times, I think, forward PE, which is 35 times maybe, given the recent surge in share price. But we still think there's a little bit more room to go, especially when demand for next year is basically sold out for their Blackwell chips. Yeah. So overall, NVIDIA, still very positive. AMD a little bit less because of the two segments that have been generating data. Yeah. So hope that helped to answer those questions. I'm gonna hand it back to Paul to end up the. Thank you.
Yeah. Thanks. Yeah. Thanks, John. So thanks, John. Thanks everyone for your time and for the questions. And apologize, I think Zin was not here today to answer some of the technical questions. With that, I'd like to end the session and wish everyone have a wonderful week ahead. Thank you, everybody. Bye.